Come on.
Well, good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Friday, January 31st, 2020. And here are our top stories. We'll take a look at the University of California's retirement plans, and then we'll talk Secure Act, alternative investments, and retirement income. Well, let's welcome to the program Marco Merz. He is the head of Defined Contribution and a managing director at the University of California. Marco, thanks so much for joining us this morning.
Great to be here. Thank you, Jeff. Thanks for having me.
Yeah, it's a pleasure. It's great to always hear your perspective. So let's start off. Why don't you tell us a little bit about your role at the university and give us a background, a synopsis of what's going on at the University of California.
Yeah, so Jeff, I joined the UC about 4 years ago. I had the defined contribution effort. To give you a sense, we manage about $27 billion in defined contribution assets. Interestingly enough is that the vast majority of those assets are actually voluntarily saved. So this is not a 401k-like strategy, but really, as you can imagine, as a public entity, we still have an open and a well-defined benefit plan. However, our participants are really strong savers. They save voluntarily. Actually, over 10% of their savings rate is above what is demanded by us. I think that's another important aspect, is that in 2016, we allowed participants to choose, new hires to choose between a defined benefit plan that is now capped or a defined contribution only plan. And what we've actually seen since 2016 is that participants are choosing at a slightly higher rate, but nonetheless are choosing defined contribution only. Obviously, that has ramifications for us down the road. We will have increasingly a divided participant base, the vast majority today with a DB plan, but increasingly a not so small component of participants that don't have a guaranteed income stream. And certainly that's an area that we are concerned about. We have to think about what we were going to do. So that gives you a sense: 300,000 participants, $27 billion in assets, $10 billion in the target date fund, and the majority of the residual assets in standalone to 12 core lineup choices.
Yeah, I was going to say that's a huge number of participants, 300,000 individual participants. You mentioned that overwhelmingly, or the great majority of people are picking the DC plan over the DB. Do you have a sense for what that is attributable to? Is it just the fact, great management on your part and the board's part, or is there something that has really caught fire with respect to what the participants want?
Well, I wish it has something to do with me, but anecdotally, and we're still early days, about 3.5 years in now that we made that switch. But anecdotally, it's actually really two things. Number one is flexibility, right? Portability of the assets is relatively easy if a participant leaves to take those assets with them. And if you look at the structure and the vesting period of our defined benefit plan relative to that new DC plan, the DB plan doesn't vest until 5 years from a participant joining. The DC plan actually vests after 1 year. So you get to keep the UC contributions in defined contribution. After a year, they're yours. In the DB plan, that doesn't happen until 5 years from the time that you're joining. And I think that flexibility and the vesting of the DC plan is really the main driver of individuals opting for the defined contribution plan. This is not unique to the UC. Individuals, employees are staying shorter periods of time with employees, and I think employers, and I think that's the main driver, flexibility, why we're seeing an uptick in DC and DC only choice.
Yeah, and it seems to make sense and in line with what we have heard on the network. It used to be, Marco, that, and maybe it's still the case for a lot of professors and staff, stay at institutions for a long period of time. And that seems to be the case across the country. But it seems like, just like the regular other parts of the economy, people are moving around, doing different things. They might spend 5-10 years teaching, and maybe they want to go do some research, or maybe they want to go to a different vocation, right? I mean, we've all moved around in our careers.
Absolutely. And you and I are the old guys, right? We stick around a little bit longer at the jobs that we currently have. Yeah. but the younger generation simply is not as attached to a specific job anymore. And that's clearly what we're seeing. The average tenure when our employees are retiring is about 16 years, but you will see the new hires stick around much less. And so that, I think, is the main driver. Flexibility, ultimately, that's afforded to by the DC plan is really the core value that a new hire sees, and that's why they opt for DC only.
Yeah, it seems to be what is occurring throughout the country nationally. I want to dive into the investments because I know you have oversight of the investments and you work with your partners in human resources in terms of communication. But let's dive in a little bit deeper. Let's talk about the type of investments you have, meaning are they mutual funds? Are they separate accounts? Are they collective investment trusts? I think that would be really interesting for the audience to hear because with your size plan, $27 billion, 300,000 participants, I would imagine you have great economies of scale.
Yeah, so just from a structure perspective, our default is the target date fund. We call it Pathway. It's an open architecture, multi-manager, active, passive, hybrid strategy. We have a dedicated glide path manager, but we retain the underlying manager selection. Again, as I said, it's the default. The second tier are 12 individual asset class line items. What we try to do really here is streamline. We moved from 70 plus choices in 2014 down to now 12. We try to balance more fixed income versus equity. I think in many DC plans, you have this overhang on equity. On the equity side, we felt that just from a visual perspective, participants gravitate to equities because you offer them 30, 40 equity choices, but only fixed income, 5 or 6 of them. So that was one of the idea and the implementation that we did. The third tier is a brokerage window. As you can imagine, with a university, you will always have an economics professor that thinks they can do better than the CIO office, and hence we have a brokerage window. If you mentioned mutual funds versus separate accounts, and when we made the big changes in 2017 and 2018, we did a couple of things. First and foremost, we white labeled all of our funds. Yeah. They are now called the UCXYZ fund to make it easy and intuitive for participants to understand what we're actually offering. And secondly, the things that we really made is eliminated completely all 40 Act funds. So predominantly 5 years ago, we held mutual funds. Today, we don't have a single mutual fund left in our lineup. They're all separate accounts. A handful of collective vehicles are in there. And to give you an order of magnitude of cost savings that you're able to achieve, we reduced costs by about 60% over the last 5 years. And the average management fee of our core lineup choices is now 5 basis points. So if you think about we're lending the securities within those funds, our participants are getting those investments literally for free. And so to us, cost reduction is a free form of alpha. Obviously, we're cognizant that passive only is not the right choice. We firmly believe in a balance between active and passive solutions. To give you a sense there, and I think that's the last comment that I'll make around our core lineup, is we have a healthy mix between active and passive. Emerging markets equities are active. Fixed income is completely active. The residual is passively managed. So we believe we have a sweet spot between active and passive, but through the move from mutual funds to CITs or separate accounts, we're able to really squeeze management fees to wafer thin, in our view.
Yeah, and fees matter. Before we go to break, we got about a minute left, Marco. It takes a village, right? It takes a team of professionals to deliver these results to participants. It's not just the Marco Merz show. I mean, you've got the board, right? You've got a board of people that have oversight. You presumably have people that you work with at the human resources. Do you want to just mention kind of the governance structure that you may follow at the university?
Well, if you start with the CI office here, we're about 60 individuals. Obviously, they manage not only the DC plan, but our pension, our endowment, the working capital assets of the university. If you add that all together, it's $130 billion that our team manages. I heavily leverage our fixed income team. Our fixed income team manages assets in-house. Most of the assets in our DC plan are also in-house managed. So think of our team around 60 individuals, 30 investment professionals. HR is, as you mentioned, an army. The communication aspects, the education component, the ongoing collateral that's being created is truly robust at the University of California. And I come from the investment side. Historically, I always smiled or smirked when it came to communication, but I really learned to appreciate how important communicating is and ensuring that participants understand what you're offering. And so that symbiotic relationship between us and human resources and really explaining what we're bringing to the table is absolutely mission critical.
Yeah, sounds like it. So I want to take a quick break, Marco. When we come back, we're going to get Marco's opinion on such things as retirement income, maybe alternatives in DC, and also get his sense for the Secure Act. So stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network. Welcome back. We are talking with Marco Merz. He is Managing Director and Head of Defined Contribution for the University of California. Marco, thanks so much for sticking around with us this morning.
Absolutely.
So it was a great conversation. I think you laid out for the audience very well the governance structure as well as the basics about the plan. Let's shift gears a little bit. You know, retirement income and deaccumulation at the forefront of what people in the industry and also people who are plan sponsors are thinking about. How are you thinking and how is the university thinking about deaccumulation?
I think one of the first comments that I'll make, Jeff, is that obviously we've been talking for years about guaranteed income. So I think this is more of a conversation than actual implementation. But I think that needs to be addressed. For us, this has an increased level of urgency because of that structure that we talked about earlier. We are now offering participants defined contribution only. We are a hyper-paternalistic entity, and many of our stakeholders, including our board, including our academic senate, really have heartache around participants not having some form of guaranteed income stream. So we're researching and working heavily around guaranteed income. As a matter of fact, we're meeting on Friday with our board to talk about the incorporation of a deferred annuity into the target date fund. What we want to do is ensure that our participants are hedged when it comes to longevity risk, in particular in the latter stages of their life when cognitive abilities are declining. So we believe a floor, an income guarantee, in particular around 78 and beyond, is where we really need to get this right. And so our idea is that we will leverage our target date fund. We will incorporate a deferred annuity, a QLAC, into the target date fund to allow participants to really get a baseline floor above and beyond Social Security when in our view it matters most. if you're 66 and you're starting to realize you've overspent and maybe you're starting to run out of money, it's easier to counter steer and say, let's go back to work. You can't do that when you're 78 or 80. So we really believe that that tail of your longevity risk is critically important. And that's the area where we're working hard to improve our target date fund. We're not talking about it or only talking about it. And we are actively working it with our record keeper, with our glide path manager, SSGA, to incorporate a QLAC. From a timeline perspective, the rollout of the communication will start late 2020, and the first QLAC purchase opportunity for our participants will be in 2021. So from us in our entity, we have moved from a conceptual conversation to an actual implementation strategy. And again, we believe the longer tail of longevity risk is really where we need to hone in. And we believe that's a sweet spot. We're helping participants hedge that longevity risk at the end of their life, but also retain liquidity and flexibility for them between 62 and 78. Because when you talk to participants, they love guaranteed income, but at the same time, they value flexibility, liquidity of assets. And so we believe this is a sweet spot. We retain a large amount of assets in a liquid, diversified portfolio. They can buy and sell it, but we also add a QLAC to give them that income floor when it matters.
And you also get to keep the money in the plan, which I would imagine allows you to retain those economies of scale, right? You're instead of people rolling out to an IRA or an annuity, which may or may not be a bad thing or a good thing. You know, it's an individual's choice, but I think it would probably allow you to retain the economies of scale, which ultimately helps you keep your fees in check.
Absolutely, and this goes well beyond just the QLAC or our target date fund. Again, we're very paternalistic. We don't want to get retirees or people that have left the university. We don't want them out of our plan, out of our 403B, our 457 plan, because we firmly believe they're not going to be able to get those economies of scale anywhere else. I'll give you an example. Our US large cap equity strategy, we pay half a basis point for that, right? You cannot go out into the market as an individual on the retail side to get that type of cost.
Yeah, I think a lot of people kind of miss that. They believe that moving out gives them access to more investments, and I'm not sure that that's really something that they think about. Just shifting gears, Marco, I'd be remiss if I didn't ask you about alternative investments. You know, you have them, presumably have them in your defined benefit plan. When I'm talking about private markets like private equity and hedge funds and private debt and things that I don't even understand really. But what's your take? What's the board's take on alts in DC?
So if you want to step back a little bit and think about alts a little more broadly, not our view only, is that you've had some plan sponsors try it, they ended up being litigated, and so there's been this tremendous headwind around alternatives, which in my view is really a shame. The reality is, and I think the consensus from everyone that you will talk to, Jeff, and I'm sure you've heard this, is lower expected returns, lower returns for fixed income, lower returns for public equity. That has a meaningful impact when it comes to wealth accumulation. So the question that we all need to ask ourselves is, how can we ensure that expected returns are as large as possible, obviously risk controlled? And I do believe that we have a too tight of a funnel in defined contribution by excluding, in particular, private equity and private real estate. I think we're a poster child of the almost schizophrenic approach to defined benefit and defined contribution management. I am a participant in our defined benefit plan. So for Marco on the DB side, private equity, private real estate, absolute returns strategies, real asset strategies are good and important and part of my implicit portfolio. But the same Marco that now has assets in the DC plan shouldn't hold them. Doesn't make sense. Too expensive, too risky. That's a complete disconnect. So in our view, incorporating alternatives is going to be extremely important as we go down the road, and in our view will start seeing lower returns into the future. So we are extremely interested in adding alts. Obviously, there's some operational challenges there. Fees are one of them. I think that's a lesser problem. Sometimes you hear around liquidity, they're not liquid. If they're incorporated in a target date fund, I don't think liquidity is really an argument. You will hear fair valuation as a challenge or a problem, where people will tell you, well, you shouldn't include it because you can't fair value it. So we've done some research around that. How can you strike an artificial NAV for private assets? So there's a whole bunch of work that we're doing. We believe down the road, alternative assets need to be in a target date fund, need to be in a defined contribution plan. I'll give you one anecdotal point around this. When we talk on the DB side and our endowment to our private managers, doesn't matter who it is. If you talk to a Sequoia in the venture space, if you talk to Apollo or Blackstone in the more mid to large buyout space, one theme that is consistent, they will tell you companies stay private for longer. And if that is true, if wealth creation, if equity growth happens on the private side, a DC plan without exposure to alternatives will miss out and will lose that opportunity for growth. So if that premise does play out, and we are starting to see that wealth creation happens on the private side because Sequoia will sell their venture funds that are starting to mature rather than IPOing a fund, they're actually selling it to their growth fund and it stays private longer. That means that equity growth is happening on the private side, not on the public side. It's a real problem for defined contribution. Obviously, this needs to be done right, needs to be done on a risk-adjusted basis. But nonetheless, it is mission critical down the road, in our view, to incorporate alternatives. And you, me, the industry as a whole needs to think about how do we tackle this and really put all of our minds together. And from a plan sponsor, asset manager, from an industry perspective like you, an industry leader, we need to think about how do we approach this as one team to ensure that alts are not forgotten or simply because there's perceived headwinds not addressed and not incorporated. So we're bullish on alternatives in DC. It will take time, but to me, it's a no-brainer.
Yeah, I think it will take time. I think you make some great points. And you've got the deep research bench especially, so it would make sense that if you're doing the research over here for the E&F, the Endowment and Foundation, and the DB, why wouldn't you just incorporate that research in the DC, even though there are some litigative concerns, if that's even a word, litigation concerns. So I guess more to come on that. Marco Merz, always a pleasure chatting with you. Really great to get your opinion, and we look forward to having you back on the program very soon.
Thank you, Jeff. Have a good day. Bye.
And that wraps up this episode of BRN AM and our shows for the week. But don't fret, because we're back again tomorrow for Saturday's edition of BRN Weekly, when we look back at the best segments for the week. And also, don't forget, you can always check out the latest news in retirement, markets, technology, personal finance, and so much more in today's edition of The Morning Pulse. So until tomorrow, I'm Jeff Snyder. Keep on saving, and don't forget, roll with the changes.